Let me tell you something that most financial gurus won't say out loud. The reason most people never build real wealth has nothing to do with intelligence. It has nothing to do with luck. And it has absolutely nothing to do with the economy. I watched brilliant engineers, talented lawyers, high-performing salespeople, people who could run circles around me intellectually, die without a dollar to their name beyond their home equity. And I have watched people of completely average intelligence become extraordinarily wealthy over the course of 40 years. The difference was not what they knew. The difference was what they did every single day without thinking about it. Habits, specifically the habits that feel completely normal, socially acceptable, even smart, but that are quietly, systematically, and efficiently transferring your wealth to someone else's pocket. I'm not going to give you a motivational speech today. I don't believe in motivation. Motivation fades. What I'm going to give you is clarity, the kind of clarity that once you see it, you cannot unsee it. And if you're in your 20s or 30s and you watch this video and actually understand what I'm about to tell you, you will be decades ahead of almost everyone around you. Stay with me. This matters more than you think. The first habit, and I'll be direct about this, is the habit of accepting being underpaid and calling it stability. Now I want you to think carefully about what a salary actually is. A salary is a negotiated contract between you and an employer. You produce value, they compensate you for it. That's the whole arrangement. Simple, clean, logical. But here's what actually happens in the real world. Companies, and I know this intimately from sitting on boards for decades, companies do not pay you what you're worth. They pay you the minimum amount necessary to keep you from walking out the door. That is the actual strategy. It is not malicious. It is rational behavior from the employer's perspective. They have shareholders. They have margins. Every dollar they save on salary goes somewhere else on the balance sheet. So understanding that, the question becomes, what are you doing about it? Most people do nothing. They accept the 3% annual raise. They tell themselves they're being loyal. They convince themselves that loyalty will be rewarded, and then 10 years later, they wake up earning barely more in real terms than they did at the start, because inflation ate the rest. Let me give you a number that changed how I thought about this decades ago. The average salary increase when you stay at a company year over year is somewhere between 3 and 5%. The average salary increase when you leave and go to a competitor is between 15 and 30%, sometimes more. Read that again. You're potentially leaving 25% of your annual income on the table. Not because you're lazy, not because you're incompetent, but because you're comfortable. Because the discomfort of job searching feels worse than the slow financial bleed of being underpaid. Now, I want to be precise here because I don't want you walking away with the wrong lesson. I am not telling you to become a mercenary. I am not telling you to job hop every 6 months chasing any marginal salary increase. That has its own costs, loss of institutional knowledge, interrupted compounding of relationships, reputation risk. What I am telling you is this. Know your market value. Know it precisely. Talk to recruiters, look at what competitors are paying, have the uncomfortable conversation with your manager about compensation. And if after all of that the company you work for continues to pay you meaningfully below market, leave without guilt. Because here's the mathematics that nobody talks about. If you're earning $60,000 a year and you switch jobs and get to $75,000, that $15,000 difference, invested consistently over 30 years at a conservative 8% annual return, becomes over $1.8 million. One job change, one uncomfortable conversation, $1.8 million. That is not a rounding error. That is the difference between retiring with dignity and working until your body gives out. The middle class calls this risk. I call the alternative far riskier. Now we get to perhaps the most insidious trap of all. Not because it's hidden, but because it disguises itself as success. Lifestyle inflation. Here's the pattern, and I want you to watch this carefully because I guarantee you have either done this or someone very close to you has. Person gets a promotion, person gets a raise, person feels rightfully that they've earned something, and then within 6 months all of that additional income has been absorbed into a higher monthly payment on something they now consider normal. New car lease, upgraded apartment, better restaurants, premium subscriptions, nice gym membership, weekend trips. None of these things are individually unreasonable, but the aggregate effect is that you've raised your baseline cost of living to match your income. which means your financial position relative to building wealth hasn't improved at all. You're running faster, but you're still on the same treadmill. Let me talk about cars specifically, because this is where I see the most damage done to middle-class wealth accumulation. The car industry, and I say this with complete respect for the engineering involved, the car industry has constructed a financial product so destructive to personal wealth that if it were sold as an investment, it would be illegal. A depreciating asset financed at interest with monthly payments that continue whether you use the asset or not, wrapped in social pressure that makes owning an expensive version of it feel like a mark of success. The average new car payment in America today is over $700 a month. That's $8,400 a year after tax dollars, mind you, money that has already been taxed before it reaches your bank account. A reasonable guideline, and I think this is worth memorizing, is that your total car costs, payment, insurance, maintenance, fuel, everything should not exceed 15% of your gross annual income. If you earn $60,000, that means $9,000 a year total on your vehicle situation. That's a very different car than what the dealership will cheerfully finance for you and homes. I need to address homes. I am not anti-home ownership. Property has been a reliable store of value for most of human history. But I have watched ordinary people make themselves poor buying houses, specifically buying more house than they needed because the bank approved them for it. The bank approving you for a $400,000 mortgage is not the bank telling you that you can comfortably afford a $400,000 mortgage. The bank is telling you they believe you can make payments without defaulting. That is a completely different calculation from what is actually prudent for your financial life. The traditional guideline, housing cost at no more than 28% of your gross income, exists because someone did the math on what happens when you exceed it. When you exceed it, you have no margin. No margin means no investing. No investing means no compounding. No compounding means you work until you physically cannot work anymore. Here is what the wealthy do differently, and I've observed this across hundreds of people over 60 years of investing. Wealthy people buy assets first and upgrade their lifestyle second. They tolerate a gap between what they earn and what they spend, and they direct that gap aggressively toward things that produce more money. Then when the assets are generating real cash flow, they upgrade their life from that cash flow, not from their salary. The middle class does the reverse. Upgrade life first, try to figure out investing later. Later never comes. Third habit. And this one became devastatingly apparent to millions of people in 2020. Relying on a single source of income. I want to be careful how I frame this, because there is a version of this conversation that becomes impractical noise. Just start a side hustle. Just start a business without any acknowledgement of how genuinely difficult that is when you're working full-time, managing a family, and already stretched thin. So let me be realistic with you. The first and most important step isn't building a complex income empire. The first step is simply recognizing that having one income stream is a structural vulnerability. It is not a character flaw. It is not laziness. It is a systemic risk that needs to be managed, like any other risk. When you work for a single employer, that employer controls 100% of your income. They can reduce it. They can eliminate it. They can restructure your role away. They can decide for completely arbitrary reasons having nothing to do with your performance that your department no longer serves the strategic direction of the company. And when that happens, your cash flow goes to zero overnight. Now think about what zero cash flow means when you have a mortgage payment, a car payment, subscriptions, children, and a lifestyle calibrated to your previous income. It means crisis, immediate, urgent crisis. The wealthy do not operate this way, not because they're lazy. Many of the wealthiest people I've known are among the hardest workers I've ever met, but because they understand that money can work in parallel with labor. You sell your time once. You can deploy capital in multiple directions simultaneously. So what does this practically look like for someone who isn't wealthy yet? The starting point is investment income. Even a modest index fund position built over years begins to produce dividends, however small. Those dividends represent income that doesn't require to show up anywhere. They arrive regardless of whether your employer is happy with your quarterly review. Beyond that, and I'll be honest, the order matters. Real estate income for those who are positioned to manage it. A second skill monetized, whether freelance work, consulting, or a small service business. Online income if you have knowledge worth sharing. None of these are overnight solutions. They all require patience and consistency. But the point isn't how large these secondary streams are initially. The point is that they exist, because once they exist, you are no longer one phone call away from complete financial crisis. And that shift from fragility to resilience changes how you make decisions in every other area of your life. You negotiate differently when you need the job less. You take calculated risks differently when your family's survival doesn't depend on a single outcome. Now I want to talk about something that I consider one of the genuine miracles of mathematics and the tragedy of how few people actually take advantage of it. Compounding. Einstein may or may not have called it the eighth wonder of the world. The attribution is disputed, but the mathematics is indisputable, and it is genuinely extraordinary when you spend time actually understanding it. Here's a simple illustration that I want you to sit with rather than rush past. Two people, same income, same capacity to invest. Person A starts investing at 22 years old, invests consistently for 10 years, and stops completely at 32. Never invests another dollar. Person B waits, spends their 20s living life, starts investing at 32. Invests consistently for 30 years, never stops. Common sense says person B, who invested for 30 years versus 10, would have far more money, but they don't. In most realistic scenarios, person A, who started earlier and stopped earlier, ends up with more money because of the additional decade of compounding at the beginning. The start date matters more than almost anything else. And this is a habit I want to name precisely. Most people in their 20s and 30s treat retirement investing as something to do eventually, when they have more money, when they feel more so, when the kids are older, when they understand it better. Every one of those when statements is costing them compound growth that cannot be recovered. I want to be specific about what to actually do here, because vague advice about investing helps no one. If you don't know where to start, index funds, specifically broad market index funds that track the total market or the S&P 500 with the lowest possible fees. Not because they're glamorous, not because they'll make you rich overnight, but because over any 30-year period in modern market history, they have produced returns that outperform the vast majority of actively managed funds, and they do it without requiring you to become a financial analyst. The second instrument worth understanding is a target date retirement fund. You choose the year you expect to retire. The fund automatically adjusts its allocation from growth-oriented to conservative as you approach that date. It removes the behavioral errors that come from trying to time the market or manage allocation yourself. The single most important thing you can do for your retirement is start whatever amount you can start with. $20 a month is better than waiting until you can do $2,000, because the habit matters as much as the amount, and the compound interest starts the day you begin. There is no financial decision you will ever make that has higher expected return than starting early and continuing consistently. I have watched this play out over 6 decades of investing. There are no exceptions to the math. Fifth habit, and this one requires a shift in how you conceptually frame money. Most people think about money in terms of income and expenses. Money comes in, money goes out. Try to make more come in than goes out. That's the basic framework most people are operating with. I want to offer you a more useful lens. Production versus consumption. Every financial transaction you engage in either produces value or consumes it. When you work, you produce. When you invest, you deploy capital into something that produces. When you buy a liability, a car that depreciates, a subscription that provides entertainment, a meal at an expensive restaurant, you consume. Now, consumption is not evil. Do not misread this. Consumption is human. Consumption is often the entire point of building wealth, to eventually consume things that bring you joy and meaning. I am not suggesting a life of monastic deprivation, but the ratio matters dramatically. The average American carries personal debt of over $96,000. Average, that is not the bottom of the income distribution. That is the statistical average across people at all income levels, which means there are plenty of six-figure earners included in that average who have structured their financial lives such that consumption is chronically exceeding production. The financial position of any individual can be roughly understood by examining whether their production to consumption ratio is trending positive or negative. If more is leaving than arriving, and that gap is being bridged by debt, the mathematical trajectory of that life is deterioration. Slowly, then quickly. What shifts this ratio? Reducing consumption is part of it, but it's the less interesting part, and frankly, the part people find most psychologically difficult to sustain. Humans adapt to reduced consumption poorly over time. The more powerful lever is increasing production, not just by working more hours because hours are finite, but by building assets that produce without requiring your time. Every dollar you invest is a dollar working for you in parallel. The dividend it generates is production without labor. The compound growth it accumulates is production without effort. The wealthiest people in the world are not wealthier primarily because they work harder than you. They are wealthier because a larger percentage of their net worth is in productive assets rather than consumable ones. Their money is making money while they sleep, while they vacation, while they do anything at all. This is the actual game. Not the salary, not the title, not the neighborhood you live in, whether your assets are growing independent of your daily effort. Sixth habit. I'll be honest, this is the one that frustrates me most. Not because people are stupid, but because this is entirely self-inflicted. Ignoring financial literacy, we live in a society that has collectively decided that knowing how to read a Shakespearean sonnet is essential education. But understanding how compound interest works, how taxes function, how to read a financial statement, how to evaluate an asset, none of that needs to be explicitly taught. You're expected to figure it out on your own, presumably through osmosis or suffering. The result is exactly what you'd expect. Generations of intelligent, capable, hardworking people who are financially illiterate, not because they couldn't learn, but because nobody ever taught them, and the consequences of not knowing felt distant until suddenly they didn't. Let me identify the specific knowledge gaps that cost people the most. Taxes. Most people know their tax bracket, but do not understand how to use legal, legitimate tax advantage vehicles to reduce what they owe. A 401k contribution is not just a retirement account. It is a tax reduction mechanism. Contributing to it reduces your taxable income dollar for dollar up to the contribution limit. An IRA, particularly a Roth IRA for younger earners, allows your money to go tax-free and be withdrawn tax-free in retirement. Health savings accounts triple tax benefits, tax-deductible contributions, tax-free growth, tax-free withdrawals for medical expenses. These are not loopholes. They are instruments designed specifically for ordinary people. But you have to know they exist to use them, understanding the difference between an asset and a liability. This is not complicated, but it is not commonly understood. An asset puts money in your pocket. A liability takes money out. A rental property that generates monthly income above its costs is an asset. A personal home that requires mortgage payments, maintenance, and property taxes with no offsetting income is a liability, a potentially appreciating liability, but a liability nonetheless in terms of monthly cash flow. The fee problem. Investment fees seem small in percentage terms. A 1% annual management fee doesn't sound like much, but over 30 years on a substantial portfolio, a 1% fee difference can consume hundreds of thousands of dollars in growth. Index funds charging 0.03% versus actively managed funds charging 1.2%. That difference in fees compounded over decades is not trivial. It is enormous. Financial literacy is not about becoming an expert. It is about understanding enough to make good decisions and avoid catastrophic ones. The investment required is relatively small, a handful of books, a willingness to spend time understanding the basics, and the return is exceptional. Ignoring it because it feels complicated or boring is the intellectual equivalent of choosing not to read because books are long. You can do it. You're choosing not to. And the consequences of that choice will follow you for the rest of your financial life. Last one. And I've saved this one for last because I think it's the deepest root of all the others. Doing what everyone else is doing, spending to fit in, confusing the appearance of wealth with actual wealth. I want to tell you something about the genuinely wealthy people I have known over 60 years of business. And I've known hundreds of them. The ones who built it themselves, not the ones who inherited it. Almost none of them look the way you'd expect. They drive reasonable cars. They live in houses that are comfortable but not ostentatious. They wear clothes from ordinary stores. They do not announce their wealth and their choices. What they have instead of visible status symbols is something far more valuable. Options. Freedom. The ability to say no to things they don't want to do and yes to things they do. The middle class, and I mean this without condescension because this is a systemic cultural pressure, not a personal failing. The middle class spends money they do not have on things they do not need to impress people. They do not like to maintain a social position that gives them anxiety rather than joy. Social media has accelerated this into a kind of financial psychosis. People are now making daily spending decisions on clothes, on restaurants, on vacations, on cars, based on what will look best in a photograph taken for an audience of acquaintances. This is not wealth building, this is performance, and it is extraordinarily expensive performance. I want to ask you a question that I want you to sit with genuinely. If nobody could see what you owned, if your possessions were invisible to everyone except you, would you buy the same things? For many people, the honest answer to that question reveals something uncomfortable about what is actually driving their spending. Not joy, not need, not genuine preference, appearance, social currency, status. Now, I am not suggesting you live like an ascetic monk. Joy matters, experiences matter. There is no virtue in deprivation for its own sake, but there is profound value in knowing with clarity why you are spending. Whether a purchase is driven by genuine preference or social anxiety is a question worth asking every single time. The rat race that so many people feel trapped in is not primarily an economic trap. It is a psychological one. It is the endless cycle of working to earn, spending to appear successful, finding that appearance insufficient, working more, spending more, while the actual goals, the things that would genuinely improve your life, remain perpetually deferred to someday. Breaking that cycle does not require extraordinary income. It does not require a revolutionary investment strategy. It requires clarity about what you actually value. What does your life look like when it's going well? Not what does your Instagram feed look like? What does your actual life look like? When you answer that honestly, you'll often find that it costs significantly less than what you're currently spending, and that the gap between what you're spending and what you actually need is exactly the capital you need to start building the life you claim to want. Let me summarize what I've walked you through today. You may be working for significantly less than the market would pay you, and the discomfort of changing that is costing you potentially millions over a lifetime. You may be buying things, cars, houses, experiences, at a level calibrated to impress rather than to build. And that gap between what you spend and what you need is the exact wealth you're leaving on the table. You may be entirely dependent on a single employer for your financial survival, which means one decision made in a boardroom you'll never enter can end your income overnight. You may be delaying the single most powerful financial tool available to you, compound growth from early investing, because someday feels safer than today. You may be consuming faster than you're producing and bridging the gap with debt that quietly compounds against you in the wrong direction. You may be choosing not to understand money, taxes, assets, fees, vehicles, when the cost of that ignorance vastly exceeds the discomfort of learning. And you may be spending based on what others think rather than on what you actually want, which means you're funding a performance rather than a life. None of these are inevitable. Every single one of them is a choice, often an unconscious one, which is why naming them matters. You cannot change a habit you haven't identified. I have spent the better part of my adult life studying why some people build wealth and others don't. The answer is almost never talent. It is almost never luck. It is almost never circumstance. It is decisions made consistently over long periods of time with clear eyes about what is actually happening versus what feels comfortable to believe. You have those eyes. Use them.